Afternoon folks, my name is Ben Wright. I'm the Director of Commercial Development at ATPI Innovations. ATPI Innovations is Australia's largest technology incubator. So we're located in Everleigh in Sydney, right next to Readiness train station. And we're an institution owned by 4 universities, ANU, UTS, Sydney University and the University of New South Wales. We currently house 67 startup companies across life science, engineering and ICT. Anne-Marie's actually covered a lot of what I was going to talk about today. It must be fun. Once you get out of the research domain, you decide you actually want to do something with your technology and you want to commercialise it. And you're either going to spin that out or you're going to start up your own business. The likelihood is that you're going to need to resource funds from somewhere. And so the question then is, how much do you actually need? The basic formula is X equals Y over T. So I need $1 million in order to take this technology to first customer over the next 6 months. So it's the quantum, the activity over time. And that's really the story that you then present to people like angel investors. The thing that you want their buy-in. So what are your goals with that process?
See, I wasn't making it up.
So, he's got a bigger valley though.
Yeah.
I was kind
It's a
He's a pessimist.
The valley of death is really, it's the point at which you're spending money and you're not generating any real revenue, or you're not cash flow positive. And depending on your business, that can range from prototypes all the way through to IPO. So it really is, it's industry dependent and technology dependent, the size of that gap. But how are you going to get there? The different resources are to look at bootstrapping your business. So bootstrapping means you dig deep into your pockets and you start with your own money, and then possibly use the organic growth or revenue generated through your customers to continue to build that business. There's crowdfunding. People have heard of Kickstarter, Possible, those sorts of businesses. So crowdfunding is a really great way of getting social proof that people want your product without having to give away equity.
There's crowd investment as well.
Crowd investment
And
as well,
crowd
yeah.
actually.
Well, I think who's it? Artesian doing a fund that's based on crowdfunding, isn't it?
Yeah.
It's equity based. Hasn't gone through it yet.
They have an equity-based crowdfunding, which is interesting.
And I think there are legal issues that are trying to overcome that.
Yeah, that's
as well. But you do have businesses like Ninja Blocks at ATP Innovations. So they have a sensor network with a cloud-based programming language, so that you or I or anyone else who doesn't have great domain expertise in programming can actually go and program sensors around the home for temperature, distance, pressure, those sorts of things. So if the dog barks too loudly, turn the sprinklers on, that kind of stuff. So they've launched 2 successful Kickstarter campaigns. The latest one raised over $700,000 from people paying for product. And they haven't yet gone to investors to ask for additional money, although it's likely to happen in the very near future. You have accelerator programs, which I'll focus on a little bit later. Accelerator programs are programs that provide a very small amount of seed capital, but a lot of domain expertise to help you shape your very early stage business and validate customers. And that's really the proof that's then required in order to gain angel investment. And so angel investors around the place, there's just some of them, and you have Capital Angels, and then up in Sydney, Sydney Angel Network. They're both very active angel investor networks with investors who understand risk. And that's really important for an early stage business. They're investors normally that have a balanced portfolio of some sort, so they invest in blue chip, they invest in housing and those sorts of things, but they like excitement. And startups really are the sex and violence of investing. So,
Well, a lot of them have done it before and then they've gotten comfortable and then they just use it.
Yeah. So you have angel investors, and angel investors typically tap out in Sydney, a little bit higher, so $500,000 or thereabouts.
Oh, we would have $500,000 investments,
Yeah.
but the average is that sort of 50 to 250.
And you also have super angels. So these are individuals who are really cashed up and can put in $1 or $2 million of their own money without having to syndicate an investment.
We have had one in Cameron's recently, $2 million.
Yeah.
Private money. One guy invested $2 million in a company in Cameron.
So if you have the right idea and the right relationships, then that's the sort of money that can come through, that you can find through angels. There are university-based venture funds and ESVCLPs. So ESVCLPs are the early stage venture funds that Anne-Marie was talking about. They're typically $10 to $20 million funds. So they can typically afford to put in between $1 and $2 million into an investment over the lifetime of their fund. Through New South Wales Health there, they've got a medical device fund, which is $5 million a year for medical devices in particular, which is a nice thing to have. They didn't issue money for the first few rounds, but took applications. So their first round, they gave away $10.3 million, so that was last year. They're giving away another $7.7 million this year, and then I think it'll be $5 million enduring after that. So that's a great little fund too. And then you have at the upper end, kind of your traditional venture capital. People like NH Carnegie, GBS, Brandon Capital, Starfish, One Ventures, Southern Cross Venture Partners, and they're kind of the big boys in town. They're the ones that will play somewhere between $2 and $20 million in an investment over the lifetime of the fund. Understanding the funds themselves for a typical venture fund last for about 10 years. So they'll normally try and put all of their money into businesses in the first 5 to 6 years and spend the last 4 years or so trying to get their money back out. So that the realisation is they need a return over that sort of period of time. Largest fund in Australia currently is Southern Cross Venture Partners Clean Energy Fund. So that's a $200 million fund. That coincidentally is kind of the typical size of a fund in the US. So are you ready for investment is a question. There are different scales that you can use for investment readiness, and it really depends on where your technology space is and what industry verticals you're working in. So if you're a software or a product or an app, your investment readiness may be very, very different to somebody that's working in medical devices or drug development. But typically, it's identifying what your business model is, looking at the market size, validating your problem and solution, and then working all the way through so that you've got a minimum viable product, so a demonstrable product that you can put in front of people and say, hey, would you buy this in its current state with the features that it offers, and then working your way through until you've got a really good understanding of the metrics of your business. As you progress through that investment readiness level or progression, your valuation for the business changes. So at the bottom of the cycle down here, you may have to give up 30% of your business for $100,000. As you get up to the top, it may be 30% of your business for $20 million. So understanding where you sit within that investment readiness cycle is really important. As an example, here's a medical technologies readiness level. So have you got an effective team with the right skill sets? You have a compelling clinical need? You have an attractive solution, and have you identified what the minimum viable product's going to be? Are you free to operate? So when you're trying to patent the thing, are you infringing anyone else's patents? Or are you trying to patent something that's already in the public domain? Can you get regulatory affairs approval, so TGA, FDA, CE mark, those sorts of things? And then, have you identified who the users, choosers, and payers are, so the customers within your demographic? Because in a life science business, the users, choosers, and payers are likely to be all different. So if you're building an app, okay, the person that uses the app, chooses the app, and pays for that app is probably the one person. If you've got a medical device, the person that chooses to use the medical device may be a surgeon. The user may be a surgeon, the person that chooses that device may be a chief technical officer within a hospital, and it may be a medical insurer that then is the payer. So you have to satisfy all of those customers. Understanding them is critical to get investment. And then it comes down to, do you know what you don't know? I think that quote there is the favourite quote of the CIA. So we don't know what we don't know. And incubators and accelerators are assets that are out there that are available to you as an entrepreneur that will help you to find the things that you don't know and then enable you to execute on a business plan. And so your business really is, this is the problem and this is the vision I have for fixing that problem. What you're unlikely to know at the time is exactly who the customer is. So what colour undies do they wear? What do they have for breakfast? What sport team do they watch? Those sorts of things. A really good deep understanding of who the competitors are and what your competitive advantage is in that market space. For us, it's very important at ATP Innovations that you have a sustainable competitive advantage. So that is something that protects your business model through IP, whether it's proprietary software, an algorithm, or a patent, or plant breeders' rights, those sorts of things. Do you have the right skills and experience within your business in order to be able to execute it? And that's an area where people like Lighthouse can be particularly useful. They can help provide you with those skills and identify the skills that you're lacking so that you can bring on the right people. And then maybe they'll identify the right people to bring on to assist you. And then dollars. So that original formula, X equals Y over T. How much do you actually require in order to achieve your goals over a period of time? And that really then is the business. Accelerator programs are then programs that are designed to enable you to execute on that business as rapidly as possible and validate your technology or your product within a market with a customer demographic. Accelerator programs provide a very small amount of seed capital. They give you access to mentors with domain expertise in a particular area. So for a new program that we're just launching in Canberra, which I'll go over a little bit later, that focuses on startups accessing government as customers. They give you an education in entrepreneurship, and they give you a safe little space in which to build your business. There's also a benefit in co-locating with other businesses going through the same stages at the same time and bonding really with those people, because it's kind of like military going through boot camp. Okay, it's tough. People bond through adversity. And in an accelerator program, you will suffer. Putting it out there, the majority of founders through accelerator programs go through some sort of breakdown within a 3 to 6 month period of time, and then they get built back up, and it's healthy. Global Accelerators, so Y Combinator started in 2008. It's the granddaddy of accelerator programs. It's now had a little over 500 startups go through that program, and 306 of them have raised money. That's a really important number because in Australia, 4.8% of technology-based startups raise money. In the US, it's only 8%. So if you look at the statistics for Y Combinator, it's quite impressive. Those 306 startups have raised $1.7 billion in capital. And the combined valuation of those businesses is now $13.7 billion. So notable businesses that you may recognise out of there are businesses like Airbnb. Techstars is another one based out of Boulder in Colorado. 22 of their companies have gone on to raise $1.5 million with a similar process. And then StartMate was the first program of its kind in Australia. StartMate is an ICT or a web mobile focused accelerator program based out of ATP Innovations. They've been running for 4 years. 29 startups go through, 8 of them through the last program, which finishes today, actually. So they're off to the US tomorrow. They spend 3 months at ATP Innovations, and they spend 2 months in Palo Alto as part of the program, bonding with investors and building their businesses. Importantly, from StartMate's perspective, 50% of the businesses have gone on to raise between $1 and $1.5 million within 6 months of the program. So when you compare that to 4.8% across Australia, they're pretty compelling. And they've already had their first exit. So I think within about a month of exiting the first cycle of the first cohort, one of the businesses sold to Walmart for $5 million. which is kind of nice, pays back the fund and builds credibility for the program. At ATP Innovations, we also run Ignition Labs. That's so far run a clean technology cohort and most recently a medical devices cohort. And we house some of the student incubator programs, accelerator programs as well. Incubators probably the standout one of those out of Sydney University. They've now run 3 classes, 3 cohorts. I think about 16 companies in total, and 3 of those, to my knowledge, have gone on to raise money. So that's really awesome for students to go out and validate a business concept, start a business, raise money on it, and try and make something real. Can actually create impact for people and places. So that brings us to Griffin. So Griffin was launched, I think on the 27th of March. It provides $25,000 to $50,000 to successful applicants, so it's a competitive process. Over 3 to 6 months, gives you access to experienced mentors with domain expertise, an entrepreneurial education, access to investor networks, and importantly, customer networks, particularly given the domain of the Griffin program, and then office space. So Griffin's 2014 program will be for startups servicing government. So government can be a customer, they don't have to be the customer for the Griffin program. As long as Griffin, yes.
Would that include people like not-for-profit organisations who have contracts with government? So they're a non-government organisation?
If you change that and said a for-profit business that then uses those profits to increase the impact that business can have,
Right.
then maybe yes.
Right, okay.
So the reason I say that is that the mentors in this program, all of the mentors in this program actually invest. So the mentors put money into a trust fund, and that fund is then what's used to provide the $25,000 to $50,000 to the companies going through the program.
Yeah.
They need to see a return on their investment, so it's an economic investment for them.
Yes.
So those startups could be software for government, they could be defence, health, education. It really doesn't matter what the space is, as long as government's a potential customer. The key dates for that program, so applications are now open. Yeah.
Just wondering, but what if the idea also indirectly benefits the government?
It's not black and white. Okay. My suggestion would be to apply, and you'll either get knocked back and you'll get some good feedback, or you'll get accepted. And so simply the process of going through the application is probably going to be good for you. So give it a bash. There are going to be pre-programmed workshops that start from the 16th of April. There's now an events tab on the Griffin Accelerator website, which is griffinaccelerator.com.au, that gives the dates for those. They'll be looking at, they're not compulsory, but they're recommended for people who are going to apply. They'll look at structuring your business for an accelerator or further investment. They'll look at getting out of the building and engaging with customers and how to pitch properly and to shape your value proposition. And then there'll be sessions around IP and identifying what it is that you're actually trying to protect, as well as mentor roulette, which are kind of one-on-ones with mentors for 10 minutes. So you might spend an hour with 6 mentors, 10 minutes each, giving feedback on your technology or your idea. There's also going to be booked-in mentor hours for a week. So you can book in with a mentor and get some deep feedback before putting in your application. So the pre-program workshops are recommended. Final applications are due 25th of May. The program starts on the 1st of July. So anyone interested in this program needs to be able to commit at a minimum 3 months full-time from the 1st of July. So that's the real caveat there.
Okay, sounds good.